Even if you can get credit at a low interest rate, if you can't find the house that fits your financial profile, there's not much you can do. And it is at the low end of the market, usually the existing home part of the market where people are moving up.
Yeah.
And people are just not moving up. The boomers are aging in place. That part of the market is at 30-year lows in terms of supply.
We also mentioned that there might be some kind of floor under rates that the banks would put into place. Doug, can you elaborate at all on that?
Well, they do have to make money, so their mortgage rates are a spread over their cost of funds. Now, the cost of funds, if you use the Treasury rate as a proxy, suggests that mortgage rates should get down around the 4% range, given their spread over the 10-year Treasury, which is at about 2.2 today. But banks don't make money unless they have some spread. That said, their cost of funds has fallen as well. But consumers need to be confident of a couple things. One is house prices have been slowing, so they don't want to step in if they think there might be actually an outright decline, so you don't want to catch a falling knife, so to speak.
Sure.
But if they think rates are going to be down for a while, they may say, well, I'm just going to wait until the house that actually fits my profile is available, because rates don't look to be going anywhere. And that's sort of what our survey data say, is they expect actually rates to fall a bit more.
And Diana, that's what's so interesting, is that it's not like rates are down here and people are figuring it out for the first time. This is almost becoming the new expected normal.
Yeah, I mean, if you talk to a millennial and you tell them that you got a mortgage rate at 9% back in the 90s and you thought that was great, they look at you like you're insane. But Doug, I'd be interested also, and I don't want to get too wonky on this question, but I've been hearing a little bit also that while we do say that mortgage rates follow the yield on the 10-year Treasury loosely, they are mortgage-backed securities, that is bonds that investors have to buy, that also dictate rates. And we're hearing that this talk that Fannie and Freddie might come out of conservatorship, and Mark Calabria, the head of the FHFA, hasn't actually said specifically that there would be any kind of government guarantee in the new world, that investors are pulling back from mortgage-backed bonds, and that's keeping rates higher than they could actually be. Is that true?
Well, that's a possibility, I suppose. However, it's also the case that the Fed continues to run off its portfolio of mortgage-backed securities. Even though they've slowed the overall portfolio runoff, they are running off mortgage-backed securities. So that would put some pressure on spreads as well.